Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Joining us today are Foram Parekh of Indiabulls Ventures, Senthil Manikandan of Newberry Capital, and Lancelot Cunha of Value X. Thank you to all of my guests for joining me. Today on the show, we'll discuss the Yes Bank. After the 1,500 crore loss in the fourth quarter, does it still command value for making an investment? We analyze the result of the three pan-India cement players, that is ACC, Ultratech and Ambuja. While Ultratech did extremely well, the Wholesome group of companies did extremely well, and whether we should have an investment opportunity in cement. Kotak Mahindra came out with its numbers. We asked our guests how they felt of the numbers and whether the issues that are there at Yes Bank and IndusInd Bank will benefit other private lenders like an HDFC Bank, which is already trading at a record highs. And lastly, we asked our analyst about one company they believe did manage to surprise them in the fourth quarter earnings. So we're talking about companies that have already come out with numbers. So we'll start with the discussion firstly with the Yes Bank. Came out with a disappointing set of numbers. The counter did manage to correct over 30%. Today, a little bit of bounce back is seen, 4%, but there is a big cleanup that's happened on the bank. What's the way ahead? What did they make of the management commentary? We ask our guests. So, Lancelot, first of all, were you surprised with the number that Yes Bank actually posted? And after listening to the management commentary and their thesis, are you convinced that Yes Bank probably for a long-term period deserves to be a stock that one should invest in, or it's a totally avoid now?
Well, I was surprised at this kind of performance and the kind of provision. What we are also seeing is that while the stressed assets is estimated at almost 4.4% of the loans, the provision made for this quarter is only 20% of the outstanding. While there is a sense that the outstanding is backed by immovable properties and assets, I think the issue has been that Yes Bank hasn't focused on cash flows for covering the loans, and it's more asset backed. So like you've seen in all other cases, it will take time to unwind these assets and then liquidate. So definitely the provisions might go up over the coming 1 or 2 quarters, but I think the management has been quite clear as to their approach going forward, and the strategy that they have outlined is good because it's in line with what HDFC, IndusInd Bank and its peers are also following. So in that sense, the negatives have got priced in, and I think at these levels, with a book value of maybe around 100 rupees adjusted, it trades at about 1.6 times. So it's not really very expensive, and at the same time, one mustn't forget that it has a reasonably large franchise. The loan book is fairly large. They're among the 5th or 6th largest private sector bank. So given that they do have a decent franchise as far as the retail segment is concerned, and their recent moves into broking and asset management, I think from a longer term perspective, one should begin to accumulate Yes Bank. This is something that one can buy into.
Okay, so you believe that the new management will be able to turn around the bank, not at least in the near term, but most of the skeletons in the cupboard are out of Yes Bank, or you believe that one should be still cautious whether something else can also come out?
I don't think anything else is going to really come out. Whatever is there has been provided for, and normally managements, whenever they take over, they're always extra cautious. So I think that even that extra caution might not really be justified, but over the next, so I don't think that we will see further bad loans etc. coming up.
Okay, Foram, what did you all tell your clients after seeing it was down 30%? Obviously, you must have gotten a lot of calls from your clients asking what to do. What's your, as a house, what's your sense on Yes Bank?
Yeah, so we also advise for a long-term, buying opportunity at current market price.
Okay.
And though there would be many whipsaws in the banks, we don't know in the near term there might be many whipsaws, but it remains a purely investment and a portfolio bet at current valuations. This was very much expected that the new management will come and make higher provisions, and we also knew that there are going to be. Yes Bank has lended to Jet Airways and ILNFS, and all these problems were there, which is already discounted in the market, in this stock price. But we feel that most of the worst is over in the bank. The new management, churning and all is done. We don't see many churning at the top brass right now for Yes Bank. probably provisions might go higher in the next quarter, but not as higher as what we have seen, in this quarter. So I think the majority of the provisions they have already done, and it wouldn't be as much as what we have seen. So I think it's a pure, portfolio bet right now one should take, and one should definitely only if they have patience to hold for good 2 years, then only one should invest at current market price, because we have seen Axis Bank, we have seen ICICI Bank come out of this, entire mess and now bouncing to a good, profitability and a good, lifetime highs in the stock price. So Yes Bank would also come back to normalcy, but we need to give equal time as what we have given to Axis Bank and ICICI.
Yeah, but they took almost 5-6 years before they started, again. But you think that the new management will be able to turn this around?
Yes, because the fact that they have already shown such high provisions, and not being aggressive. If we hear to the latest interview of Mr. Gill, he has said growth story is intact, but then again, it wouldn't be at a higher pace what we have seen earlier, what we have seen in Rana Kapoor's tenure. So this is a management with who wants to be utterly cautious in their approach and do not want to be very aggressive. At the same time, they would be growing the bank, and Yes Bank is one of the fourth largest private sector bank. CASA, I do not see it impacting, and loan book is at good, one amongst the top 3 in the private sector bank. So I feel that we just need to give some time to Yes Bank, and it will definitely bounce to normalcy.
Okay, Senthil, is that something that you also agree to, that it's an investment opportunity that one should take, or would it be an avoid for you?
So at present I could avoid the stock, because we have to wait and watch at least next 2 to 3 quarters how the watch list pan out. Because if we study the Axis Bank, they came out of the watch list 2 years back, but if you look at the slippages has been over and above what are the watch list projections were. And now the S Bank has come out of the watch list of around 10,000 crores, and they have taken a contingent provisions of around 2,000 crores. So these 2 items you have to wait and watch at least for the next 2 or 3 quarters, how these watch lists, whether the slippages are happening only from the watch list or there is additional items added to the watch list. So with these 2 things, and with the change in management, 2 key positives I could say was one on the side, management is focusing much on the quality of their loan book instead of just on the loan growth. So they have guided for a 20% overall loan growth, so which is on a if you compare the past 4-5 years history, it's on S Bank used to do around 30% kind of growth levels, so it's slightly below that. But I think key positive is the quality of the accounting and quality of the book that the new management is eyeing is a good thing on the long run. But the short run, at least for the next 1 or 2 quarters, we have to wait and watch how the quality of the book improves, how the slippages are, and the GNP and NPA moves. And ROA is not expected to touch even 1% over the next 3-4 years. So as long as the ROA and ROE metrics slightly begin the other private sector banks, the valuations are going to be at around 1.5, 1.4 times 1 year forward book. So we don't see any huge margin of safety at these price levels.
Okay, so that's the view that's coming in on Yes Bank. It's nothing to be traded, at least in the short term. Don't buy it, at least for the short term. If you want to accumulate it for the long term, and watch out for how the bank performs over the next 2 or 3 quarters to get a sense of how things are moving at the bank. The next stock that we want to discuss is basically a sector, the cement sector. Now, 3 largest of the cement companies have come out with numbers. While Ultratech managed to surprise the street on the positive side, the expectation was ripe that cement sector will do well, but both ACC and Ambuja did manage to disappoint as far as their financials are concerned. Foram, what did you make of the numbers? What have you told your clients to do on the cement front?
Yeah, so Ultratech has come out with very good set of numbers, and we have seen that it has done good acquisitions also in the past. It has taken Binani's Nathdwara cement capacity, which has come on stream, and that is what is reflecting in the numbers. We are going to see Century cement numbers, reflecting in Q1 also. So we feel that Ultratech's number would continue to do good. We have also seen a good volume growth in Ultratech. I think it's double-digit volume growth, which is like the highest, of course, compared to Ambuja and and ACC. So we feel this trend will continue. Q4 was a seasonally good quarter for the cement pack, and that is what is reflected in the entire cement industry. And we have seen that good road construction work happening pan India in the month of April prior to election. So that would also reflect in Q1 result. Probably from Q2 we might not expect a good set of numbers because of monsoon, which is a seasonally weaker quarter for cement. But then H2 is definitely expected to be better than H1 on account of good demand from the infrastructure side, housing side. Low cost housing in the rural is auguring a lot of demand for cement as a pack, and that is why we have seen Ultratech doing all the right things by acquiring new cement plants, reducing the expenses, which would also increase to EBITDA margins. So I think out of the three, Ultratech remains a buy even at current market price.
Okay, Lancelot, is our ACC and Ambuja paying the price of not expanding capacity at the right time while the others did, and basically they are benefiting and these two are not?
No, I don't think that's the issue, because they are not running at 100% capacity in any case. But we've seen the volumes pick up being slower. In fact, for I think ACC, it was the lowest in the last 9 quarters. So that is a bit of a concern that volume pickup hasn't happened. Also, we've seen in case of ACC and Ambuja their inability really to increase realizations. So I think that it's probably also a regional effect, because Ultratech got major portion of its earnings, the EBITDA was driven by the Nathdwara unit, which the efficiencies kept in, and that gave them the additional benefits on the cost side. So overall you see that cement growth hasn't been that strong, or demand hasn't been strong as of now. But probably once the new government is in, and then we see a further thrust on infrastructure development, you should again see significant build up thereafter. So I think while valuations of Ultratech have moved up, the stock price has moved up, so it's now everything is almost priced in, including the future growth for a year. So at this point in time, one should probably wait and buy only on a dip, and if you have to buy, probably look at Ultratech as opposed to Ambuja and ACC.
Okay, so even at lower valuations, you won't recommend accumulating ACC and Ambuja at this point of time?
I think Ultratech will get the benefits of the operating leverage. So you could see much higher growth coming in from Ultratech. So if I had to choose between the three, I would prefer to buy Ultratech at lower prices as compared to ACC and Ambuja.
Okay, Senthil, is that something that you would agree, Ultratech over the wholesale companies?
Yes, sir, because basically cement being in the commodity sector, I think if you look at the players who are mostly efficient, like the lowest cost producers, are going to gain additional market share. Plus they are able to garner additional EBITDA per ton metrics. So if you look at Ultratech and Shree Cement, both of them, if you look at the EBITDA per ton or the operating profit, they are way much better than the ACC, Ambuja and other regional players. Because in the cement there are two major costs. One is the power and fuel and the freight. Being a pan-India level player, I think Ultratech has a huge advantage on the freight cost. Versus the other Ambuja, which is mostly in the west and north focused player. So I could prefer a pan-India player, and mostly is on the operating metrics side. So Ultratech stands out when the business performance wise, but we have to look at the valuations, because both Ultratech and Shree are trading at a EV per ton of around more than $200. So most of the positives are already captured in both these stocks. So for those holding the stocks, they can continue hold, but fresh investment is not recommended at this point of time.
Okay, that's the view that's coming in. I think Ultratech seems to be the preferred choice as far as cement is concerned among the three pan-India players at this point of time. The other stock we want to talk about is Kotak Mahindra Bank. Came out with numbers which were in line with estimates. The counter doing well for itself. It managed to move up in the green on Monday. Today also the counter seems to be doing well. The big question we're asking is, firstly, what do you make of Kotak? What should one do? And secondly, will Kotak and the likes of other private banks like an HDFC benefit because of issues at Yes Bank and IndusInd Bank? So that's something that we want to ask. So Senthil, I'll start with you only. The numbers, and you think that someone should, if someone is holding positions, they should switch from an IndusInd and a Yes Bank into Kotak or an HDFC Bank.
So on the numbers, I think standalone bank numbers, they have grown up at around 25%, and loan growth is also around 18%. This is on the backdrop of a stable asset quality. So standalone bank numbers are mostly in line. And if you look at their subsidiaries, I think they have did a phenomenal work on their life insurance subsidiary. So year over year, life insurance has grown by around 25%. And other subsidiaries like Kotak Securities and Kotak Prime and all these subsidiaries also doing well. But on the valuations, it's a bit steep. That's the only moot point. But for those holding IndusInd or NES, I think shifting to HDFC or Kotak at this price point is not recommended. But we prefer, among the private sector players, we prefer IDFC first.
Okay.
Because what has happened is there is a key change in the management. And with Vaidyanathan as an MD, I think he is the one who built the retail franchise of ICICI Bank. So I think going forward over the 3 to 5 year period, I think IDFC first could be from a corporate bank, they could move towards a retail franchisee, and the valuations are at 1.3, 1.4 times price to book. I think the re-rating could happen once critical level of retail liabilities or retail assets the bank has garnered. So we prefer IDFC first in the private sector banks.
No, Foram, what's your sense on Kotak numbers, and would you recommend anyone who has positions in ICICI, Yes or the IndusInd to start switching to Kotak?
So Kotak numbers have come very good. We had recommended the stock at some 1285 levels, but we wouldn't recommend someone to shift from Yes Bank or IndusInd Bank to Kotak, because of course Kotak's valuations are very high, and if we look at the numbers also, it is very much in line to what we had expected. But if we hear to the management's commentary, Mr. Uday Kotak has guided for stress in the financial sector, especially in the real estate loan book, and so we need to see whether going forward from the banking on the standalone point of view, would they retain this kind of growth numbers. Where premiumization Kotak would get is in the life insurance business, which is doing very good, and we feel that the insurance business will continue to do good on account of very good demand, and the insurance business itself is at a very nascent level, so I think that would continue to grow, and because of that it might get a good valuations. But currently I think Kotak is very richly valued, and I would recommend RBL Bank, which is a regional bank and which is growing very aggressively, whose NIM is also equivalent to Kotak's and with the likes of Kotak and HDFC Bank. So I think one should shift to RBL Bank over Kotak Bank.
Okay, and Lancelot, what did you make of the numbers, and should someone invest in Kotak at these valuations?
I think valuations are steep at this point in time, so maybe one should just wait, and if there's some correction, then could be an opportunity to buy, but not at these valuations. As far as shifting is concerned, I think while you did see some stress at IndusInd Bank and there is considerable issues at Yes Bank, I think you have to look at IndusInd Bank as an opportunity which may be even better than Yes Bank, because the stress is not really that significant, and the overall positioning of the bank is pretty, it's pretty balanced from a mix of retail as well as the corporate side. So they're not, like Yes Bank was predominantly focused on the corporate lending side, and which is where most of their deals were structured deals which had high fees coming up front and mostly asset backed. Whereas the situation is not the same as far as IndusInd Bank is concerned. So I think from a risk-reward perspective, IndusInd Bank does offer, let's say, a higher risk-reward ratio as compared to maybe a Kotak Bank. So it would be probably a good idea to stick with IndusInd rather than shifting to Kotak and maybe accumulate even at those levels.
Okay, so the consensus view I think is Kotak, no doubt the numbers were good, but valuation seemed to be a concern. Some of the stocks that are spoken about where positions can be shifted include an IDFC First, RBL Bank, or stick with IndusInd Bank. And the last stock we want to talk about is in the midst of the earnings season, and one stock that surprised our guest with the numbers that came out. Lancelot, a lot of numbers have come out already. One number that you thought that was a big surprise this time around.
I think Britannia to me was a surprise because I expected much weaker numbers going forward, but they seem to have managed to keep profitability as well as revenue growth on par with what it was over the last couple of quarters. And I think interestingly, the management has indicated that they are now going to move into the other areas. As far as dry snacks are concerned, they're focusing more on the bakery part of the business. And of course, the dairy business is seen to bring in growth. So I think premiumization and coupled with this, we should see Britannia come out with good numbers if one waits for next 1 to 2 years.
Are you concerned about the valuations, or is that?
I think valuations are high, but one has to also see the growth potential. And given that this has been one company which has over the last 2-3 years managed to create value for customers in buying higher pricing products, which has increased its profitability, I think that formula will continue. And you should see higher growth both in terms of revenue as well as in terms of margins and profits coming in.
Okay, so Britannia is one stock that surprised Lancelot on the positive side. Foram, which stock are you talking about?
So I like the numbers of Piramal Enterprise. We had seen a lot of issues in the NBFC space, especially on the housing finance companies. And despite these kind of issues, I think the housing finance for Piramal managed to give very good set of numbers. And also we do not see much of liquidity problem in the company. In the presentation, company has reported a good ALM surplus in their accounts. And even if we see at the loan book growth, it's growing at a good 58% CAGR over a period of last 4 years, and residential housing loan seems to be declining, and I think they are focusing more on the corporate lending side. So that is one positive. And looking at the demand, that we are facing for housing and low cost housing, I think this segment would definitely continue to benefit the housing finance segment. And on a consolidated basis also, if we see the debt to equity is much lower than the mean debt to equity of other housing finance companies. So that is also a big positive, which would lead Piramal to raise further capital and would not have much problem in raising capital. So that is also a positive. And I think the pharma business has also done good. They are focusing more on a higher margin side, and after selling of their formulation business, I think they have got all the strategies worked at the right place. So valuation wise, it is very attractive. I think, despite this kind of liquidity issues, they do not have any sort of problems either in the demand side or in raising capital. So I think everything is on the right path. Management is clean. They are not shifting any of their accounts to Piramal Realty's company, and that is why I think one should definitely enter at current market price.
Okay, and Senthil, which stock surprised you?
It's Bharati Infratel.
Okay.
You see, after the results, I think the stock also corrected around 10 to 12% within a day. Majorly because of the additional co-location exits that happened in the last quarter. Because most of the market expectation was that majority of the co-location exit happened during the Q2. So Q3 and Q4 should be comparatively better than the Q2 or Q3 numbers. That's one major concern from the market. But with the price correction that has happened post results, I think it's trading at a dividend yield of around 5% and a EV to EBITDA multiple of around 9 times. What we expect is that over the next 2 to 3 years, the telecom players 4G capex should start increasing, because both these Bharti, Airtel and Vodafone have been doing the rights issue on the raising funds to increase the 4G coverage to compete with Jio. So if you compare Indian market and China market, China Mobile alone has around 1.2 million towers. But if you add the Reliance Geos plus Bharti Infratel and Indus tower count, I think it's around less than 4 to 5 lakh towers. So as and when the 4G coverage increase happens, I think Bharti Infratel with the Indus merger happening over the next 2 months, they could be the major beneficiary of this. And we also expect additional revenue streams like fiber sharing plus smart cities to happen over the next 2 to 3 years. So at a 5% dividend yield and 7 to 8% free cash flow yield, I think the valuations are quite attractive at this point of time.
Okay, so that's the view that's coming in. Britannia, there is Bharti Infratel and Piramal Enterprises, which was spoken about today, were the results that managed to surprise. But with that, we are completely timed out on this edition of Hot Money. Many thanks to all of my guests for coming in. Lancelot, thank you so much for coming in. Foram, Senthil, thank you for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.